Hello everyone, welcome back to Forex Signals TV. I'm Shain Vernier, market analyst at forexsignals.com. Today we're going to take a look at spreads and spread trading. Now spreads intimidate many traders, but there's absolutely no reason for this to be the case. The concepts are very straightforward. With a bit of due diligence and study, any trader can grasp the basic idea of spreading and apply it in the open market. So what are spreads? A spread is the difference between two prices, rates, or yields. If you've ever placed a Forex trade, then you are familiar with the most well-known type, the bid-ask spread. Essentially, a spread is a difference between what buyers and sellers of an asset view as an acceptable price to complete a transaction. Now, there are many types of spreads. In this video, we will focus on those local to the derivatives markets. First things first, what's a derivative? Well, a derivatives product is a security that's price is based on one or more underlying assets. It is a contract that binds two parties, a buyer and a seller, to execute a specific transaction. Futures, forwards, options, and swaps are a few popular examples of derivatives. Now in derivatives, the spread is a difference between one contract's price to another. Could be gold to silver, could be Brent crude oil to crude oil. Derivative spreads come in all shapes and sizes, each designed to achieve a specific objective. They vary. Your goals and imagination with spreads make the sky the limit. All right, let's take a closer look at spreading and why it may be a valuable addition to your trading tool belt.
Okay, so what exactly is a spread trade? A spread trade is an aggregate position taken by going both long and short unique contracts simultaneously. Unique contracts simultaneously, that's key. Now, what is the form and function? Before we do anything in the market, we need to know what our goal is and what we're doing, why we're there, what we're doing. Number one, we're cashing in on pricing inefficiencies between derivatives contracts. And number two, our function is to assume a net long or net short market exposure. That's with regard to the individual contracts. So the biggest thing to remember about our goal, we're not necessarily calling a side of a market, meaning if we're dealing with crude oil, we're not necessarily trading saying crude's going to go up or crude's going to go down in the traditional sense. We're trading those contract values against each other and whether or not that spread's going to extend or whether it's going to contract over time. That's the big difference between spread trading and just buying or selling outrights. Now, why don't we just buy or sell an outright futures contract or our Forex contract or options or whatever we're spreading? Why not just buy or sell? Three big advantages. Number one, you have reduced volatility. Remember, you're buying something and you're selling something. You're also looking for those differences in the contract values themselves, not necessarily in the asset class. That's important. So if you see a $10 run in crude, well, obviously that's going to be reflected in your front month contract and deferred month contracts, things of that nature. So reduced volatility, lower margins because you're long and short or because you have multiple legs on your trade, your lower margins are going to be extended to you by the broker. So you can dial in your risk to a much, much greater degree than you can trading outrights. Lastly, it's just as easy. I mean, let's just go right to the chart and show you. This is just a basic line chart. That's all it is, just a basic line chart. This is WTI 6-month spread, and you can see we're just tracking price. But instead of tracking the value of WTI crude oil, we're just tracking the value of the difference between the contract values. That's it. We're just tracking the spread. So the game is the same: buy low, sell high, buy low. I mean, the game is exactly the same as you would just with outrights. Now, what are our spread types? These are the three foundational spread types. Very, very basic. For the sake of our conversation, we're probably going to stick to these. Intercontract, same product, different contracts. Same product, different contracts. That WTI spread we just looked at, that synthetic spread, that's a pretty good example where, hey, I'm buying one WTI contract and I'm selling another one, or I'm selling this one and I'm buying that one. That's the idea here. Calendar spread, front versus deferred, very, very similar to an intercontract spread. Calendar spreads are big for ag traders. A lot of folks, they like to buy or sell those ag contracts at the planting time and then do the opposite at harvest time. The idea that you're going to bring that spread in and make some money off of it is big for ag producers, and it really is a key strategy that's put into play by a lot, many institutional players. So calendar, you can capitalize on pricing inefficiencies due to seasonality. That's key. And the last one here is intermarket. Intermarket is just trading different markets against each other. We're talking about We're talking about, gold against silver. We're talking about WTI crude against Brent crude. I mean, in some cases, you're talking S&P 500 against the Nasdaq or the Dow. I mean, you're mixing and matching contracts from different markets. So that's key. The biggest thing to remember about spread types is there are a lot of them. And for the sake of this conversation, we're going to stick to these because they lead us into our example. But things like butterflies, iron condors, options contracts, bear puts, bull calls, things like that gets very, very convoluted very, very quickly. Okay, let's take a look at a real world example and see if we can't grasp some of these spreading concepts just a little bit better. Okay, real world example, we're looking at WTI crude oil futures. That's the CL contract listed on the CME Globex for trade. This is an inter-contract calendar spread. That means both legs of the spread are on the same commodity, the same product, in this case crude oil, and it's also a calendar spread, meaning time is what we're dealing with. We're trading the seasonality of crude. We're playing a front month against a deferred month. Let me show you what I mean. Let's get right back to our handy dandy chart. You can see right here, we've got the WTI crude oil 6-month spread synthetic, and you can see that this chart tracks the variance between that front month crude and that 6-month deferred contract. Let's look at the hard numbers right here. You can see right here, this is your futures table. This is your futures chain. That's what I call it. And let's look exactly where this spread comes from. Right here, December, you're printing 84.51, and down here 6 months later, you're printing 80.47 back in that June 2023 contract. So December 2022 to June 2023. Now, to us, that's not necessarily hugely important for market direction, but for the spread trader, it is vital information. Remember, these contracts, the closer a contract is to us, typically when it comes to futures, those are worth more. A bird in the hand is worth two in the bush. The idea being we have no clue what's going to happen 6 months down the line. We just think that crude oil is going to fall over time for a lot of reasons. There could be a ton of fundamental reasons involved, but that is the crux of your spread, 84.51 to 80.47. And if you go right back to the chart, you're right around that 435 range. So, and these are a little bit delayed, so there's going to be some difference in that spread. But what I would say is how we trade this is going to depend on our viewpoint towards that front month WTI and that deferred month. Now, we know we're going into the spring months, June 2023. So typically you may see a rise in price. You may see a rise in price. So the idea is being, okay, I'm in the winter time going into the spring. Would I want to buy this spread or sell this spread? Is that spread going to come in or is it going to widen? And if the answer, if you believe that you're going to grow, that June 2023 is going to increase in value and December is going to come down a bit, you're going to bet that spread's going to contract. So right here, this is a good look at a basic spread, 6-month WTI crude oil. If you believe that spread's going to contract, of course, you're going to sell the spread. The idea being you'll make money from the fall in price, the fall in the spreading value. And then also, if I believe that the opposite was true, that I thought we were going to see a divergence, not a convergence, but a divergence in those contract values, then I would be buying here. I'd be going long, and I would look for this spread to return to its previous glory. So always remember, all of this stuff is not that hard. The spread's charted for you. You can trade them on trading DOMs. And the biggest thing I would point out is the game is exactly the same. You sell high, you buy low, and you sell high. Essentially, that's the crux of spread trading.
So what'd you think? Probably not as hard as you thought before you watched this video. That being said, spreads scare many professional traders. Many very good traders don't understand how you could take opposing positions in different markets or the same position in the same market and expect to profit. Just remember those 3 big benefits of spreads. Make them exceedingly attractive. You have that reduced volatility. You also have lower margins, and they're easy to trade. You just pull a chart up, you buy low, sell high, you sell high, buy low. Same basic deal is your favorite Forex pair. In any case, we would absolutely love to hear from you. Be sure to leave a message below. Check us out on the socials. If you like what we're doing here, subscribe to our channel. You'll get that email blast, and you'll never be left out of what we're doing here at Forex Signals TV. All right, until next time, trade the action well, and we'll talk soon. See ya.